Hi everyone, welcome back to another video, and in today's video we're talking about 401ks, traditional IRAs and Roth IRAs. We're comparing all of them and we're making sure which one is the best for you in terms of a tax investment and a financial investment at the same time. Let's get started. Starting off with the 401ks, the best thing about a 401k plan is the limit for a 401k plan is really large compared to a IRA of any sort. The limit for a 401k right now, as of 2025, is $23,000 and $23,500 to be precise, for any taxpayer that is below the age of 50. So if you're 50 or you're above 50, you get a catch-up payment. So you can make an additional $7,500 as a contribution. There is another catch-up payment you can make if you're in the 60 bracket, but to be precise, you might need to check that up. But for anybody who's under 50, your regular limit for a 401k plan for a year is $23,500. Now, that limit compared to an IRA is really good because if somebody has the cash flow, if you have money sitting in the bank account, if your wages are comparatively higher, it's recommended that you actually max your 401k for the year. Again, it depends on your cash flow situation. If you don't have enough cash to manage your operational expenses throughout the year, then of course you need to contribute whatever you can for the year. So if you have the operational capacity for expenses, you definitely should go ahead and max your 401k out. What that will do is reduce your wages and at the same time your FICA as well. So what happens when you have a 401k through an employer? Usually what happens is you can put an amount per pay period, but at the end of the year, let's say you're looking at your tax situation and you're like, hey, I look like I'm in a higher tax bracket, or I haven't added or contributed enough to my 401k plan. Then at the end of the year, what you can do is you can increase your contributions in your software. And then what happens is, yes, you'll get less wages at the end of the year, but a lot of that portion will go to your 401k and reduce your wages. So you can catch up. It's not like you have to put in higher amount each pay period. Sometimes if you think like you're running late, you can increase those contributions towards the end of the year. Now, another great feature of a 401k plan is the employer match. So when you're contributing, your employer is also matching to that. Now, it could be 3% of your wages, it could be 4% of your wages. That's different from employer to employer, but a nice feature is that when your employer is also contributing, that's free. That's basically free money for you at the end of the day that you will get back eventually one day. So compared to an IRA, if you have a 401k with your employer, my best advice would be to focus on your 401k first and make sure that you are maxing that out to its possible extent. It wouldn't be feasible for you to go to a traditional or a Roth when you already have a retirement plan with your employer. That should be your first priority, full stop. If you have a retirement plan at work, go for that first. If you can't match it, of course, then just put all the money that you can in it. The IRAs should be your least priority at this point, because your employer will match that. So the more you contribute, the more chances you can get a better return on your investment because your employer is also pitching in. So again, great features of the 401k, higher limits, employer match is a great feature. And again, it directly reduces your wages and FICA, so that's great for you. The box one will be reduced by the same contributions you make. You'll also see a code in your box 12 as well when you get your W-2. Now on the second, we have the traditional IRA. Now, unlike the 401k plans, which have higher limits, which has the functionality of employer match, with your IRAs, you don't have that flexibility, of course, because the limits are really low for IRAs. Now, as of 2025, the limit has gone back to 7,000 for everybody. So the max you can put in is 7,000. There might be some catch up that you can put in if you're older, but you again, you gotta go and check if there's a catch up for that. But usually it's 7,000, and right now I think in 2025 it is 7,000. So that's the maximum you can put in a traditional IRA. Now the best thing about a traditional IRA is that you can contribute to a traditional IRA even after the close of the year. So what does that exactly mean is that with 401ks, if you have a 401k with your employer, the last contribution you can make is as of 12/31/2025. So after that, it's closed. You can't do anything. Anything you contribute after that goes to the next year. This is why the best thing about a traditional is, let's say you don't have a retirement plan at work, right? And you're already in 2026 and it's like February or March, and you're doing your tax numbers and you see, oh, you have a tax bill. How can I reduce that tax bill? One simple strategy is traditional IRAs, because traditional IRAs, with the traditional IRA, you can contribute to a traditional IRA. The deadline is April 15th, 2026. So basically, you get the additional 4 months to contribute towards 2025. So you can still be in 2026, but contribute towards the 2025 year. So this is a great functionality if you run into a situation where your tax bill is high. So a traditional IRA is a great option if you don't have a retirement plan at work. The problem again with traditionals is that the limit is lower, so you can only contribute up to 7,000 if you want to. Again, if you can't contribute up to 7,000, you can put maybe like 2-3,000 and see how it affects your tax numbers in whatever software you're using. You can try and see what net effect would it put on your tax bill if you pitch in like 3 or 4K or 5K, and then you can just save a few $100s on the tax return, and then again you can put some money in the traditional IRA. So this is a great functionality of a traditional, is that you get that extra time period to contribute towards it. Another great feature again is that you can defer your taxes in the way that with the traditional, you get a deduction on your tax return now. When you get the distributions later on, those are taxable. So you get a deduction every year for contributing to a traditional, and then later when you are retiring or whenever you take money out of it after the time period, you need to pay taxes at that point. But again, what we usually tell our clients is that if you're projecting that your tax rate will be lower when you're retired, of course, then it makes sense to reduce your tax bill now by contributing to a traditional rather than a Roth. You want to pay tax later when you don't have enough money coming in. So your tax rate will, of course, will be lower when you retire. So this is why traditional is a great option. If you are covered by a retirement plan at work and you want to contribute to a traditional, then there are some phase out limits that you should be aware of. And again, you want to go ahead and check that out because they change every year. For 2025, those are again different from last year, but there's a phase out limit for single filers, for married filing jointly, for head of households. So you want to go ahead and check out those phase out limits. If you're already covered by retirement plan at work, make sure to check those out, because if you go above the phase out limits, you can't contribute to a traditional. And if you do, then you get into this problem where you have to now reverse that effect. So might as well go ahead and check those phase out limits if you want to contribute to a traditional and you already have a retirement plan at work. Now, last but not the least is the Roth IRA. Now, the Roth IRA is an investment tool in a way where you don't get a tax deduction now on your return, but the withdrawals are tax-free. And a lot of people, they like Roth more. They believe or they think that they're going to have a higher tax rate when they retire, so they choose to go for a Roth. With a Roth, of course, you can't deduct any contributions on your tax return now, but when you take the distributions out later, when you retire after 55 or whenever you decide to take them out, there's also an age limit before you can't take those contributions out. And I think it's 55. You can't take the withdrawals out before that. There's a penalty involved. There's penalties with every investment tool, 401ks and IRAs as well, for age limits. So you want to make sure that you know those the age limit as well, because they don't want you to take the money out before a certain age, because if you do, then you get hit by a penalty which is called a 10% early withdrawal penalty. So to avoid that, of course, you want to make sure that you leave the money in there for a while, and then you don't get hit that by penalty. There are certain, of course, exceptions where you can take the money out, but and again, that's another topic for another video. But as long as for the Roths, this is the differentiating element in them, is that you can take the withdrawals out later tax free. So there is also an income limit for Roth, where if you're above a certain point, you can't contribute to a Roth. And this is where the backdoor Roth comes in, where you initially invest in a traditional, and then you ask your broker to convert that to a Roth, where he takes the money out. You get a 1099-R document when you have the withdrawals going out. Whenever you take money out from a retirement plan, you get a 1099-R, which is a document that the IRS gets as well. So this is how they can track if somebody is taking money out of their retirement plans. So when you do a backdoor Roth IRA, you would get one of those documents, and then you would basically put that on your tax return, and then you'll show the Roth conversion, and then hopefully if you do it right, you won't get taxed. There won't be any consequences. But again, this is something that you should consult with your broker as well. Do it properly. Make sure there's no value left in the traditional. And because in those cases, what happens is that your backdoor does get taxable, a portion of it. So you want to make sure you do it right. But this is how these are the differences between all of these financial investment tools. And again, my priority for you, if you ask me, would be a 401k. Like I said, you have more flexibility. You have the employer match, which is great at the end of the day. And again, the only downside is that you need to make sure that you keep the money in for a while. You can't take it out. Of course, you have that early penalties, early withdrawal penalty, but that is with every single retirement plan, like I said. Compared to 401ks, the traditional IRAs, the traditional IRA is great if you want to reduce your tax bill. Now, like I said, if you're not covered by a retirement plan at work, you should go for a traditional. That will help you get a deduction on your tax return, and then you can defer taxes basically by reducing your income. You'll get a benefit now, but then later when you take the withdrawals, you have to pay tax. And last but not the least, the Roth is where you basically you don't take a deduction now, and then you get the withdrawals tax free. So again, it depends on what your financial situation is. Again, you need to see if your tax rate is high right now. You want to make sure that whatever you can do, you can possibly use all the tools out there to bring it down now, and then you can pay tax later when you are basically retired, when you think the rate will be lower for you. If you think your retirement rate, tax rate will be really high, then it's a better idea to possibly go for a Roth. If you're not covered by a retirement plan at work, you can go for a Roth. But again, your first priority at the end of the day should be to max your 401k out if you have the financial capacity, if you have the cash flow, if you have enough cash in the bank aside for your operational expenses to run your house, to pay your mortgage, to pay your groceries and everything. Only then go for an investment financial tool if you think you have enough cash in the bank. So these decisions, you have to weigh them down. Keeping too much cash in the bank is going to hurt you at the end of the day. It's not doing anything for you. If you don't have enough cash in the bank, then of course you're going to run into cash flow issues. This is all for today's video. I hope you guys got some value out of it. I would recommend you subscribe to our channel. You follow us for daily videos like these. The goal is to make sure that we educate small taxpayers like you for the upcoming tax season. And if you want to go ahead and get your taxes done through us, go ahead and hit us in the comment and we'll contact you. Thank you. Have a great day.